Welcome to another edition of Yahoo Finance Uncut. I am your host, Jared Blikre, and today I have a panel with me, two very special guests. Some excellent technical analysis will be discussed forthcoming. I'm introducing now Michele Mish Schneider, Market Gauge Director of Trading and Research, as well as Dave Keller, CMT. He is a Chief Market Strategist over at stockcharts.com. Both bring a wealth of experience to the markets, to you viewers here. So let's get started. Guys, we are in the middle of February here. We're actually entering the back half of the month. Just a quick note to viewers, this is taped, so we might talk about some things, but we want to start with the big picture view because this year it's all about what has not worked last year. So you take a look at some of the biggest winners this year, from Tesla to Peloton. These were the stocks that were getting hammered last year. Dow is no longer leading. It's lagging the NASDAQ. And there's been a lot of talk about short covering. We got the Fed in everybody's crosshairs talking a pretty hawkish game here. The market's somewhat discounting it. And meanwhile, the NASDAQ, S&P 500, Dow, they're down a little bit today, but still not that far off their most recent high, which is the recent highs for the year. So let's start with you, Dave, and just give us your big picture view of where we are.
I mean, it's been an incredible run off the October lows for sure, Jared. And when I think about charting in general, you take a step back from the monitor. It's all about change of character, right? When is something different? When can you tell that the chart tells you that there's been an inflection or there's been a rotation? And the market leading up to October 22 versus the market after October 22 are very, very different. I would say two key things changed. Number one, rates went from going straight up for the 10-year to 4.25 to coming off. And you have the dollar, which had been on a rip to the upside through most of the year, all of a sudden pulling back. And that gives a room for growth stocks to really start to flourish. And that's been the biggest change that I think we've seen in the last 3 to 5 months. Is a rotation into some of the FANG stocks, things like Microsoft and Apple getting above their 200-day moving average, a lot of strength off of the lows. So that's been different. The question now for me going forward is how reasonable that is that those trends continue. Growth stocks like Tesla, like Peloton, like those kind of names, their earnings look really good as long as rates remain fairly low and as long as the dollar remains relatively weak. And if either of those things change, I think the question mark starts to come back in my head. When I'm looking at the chart of Apple and Microsoft, I'm encouraged by the fact that they're both above their 200-day moving average. That's a good thing. I was told nothing good happens below the 200-day. And so both of those key big mega cap stocks with big weightings in the S&P and the NASDAQ are holding up there. If they fail to hold, though, which is the big question mark, I think now going into February into March, I think that's when we have a risk of sort of retesting lows on the major averages.
All right, Mish, I'll give you the floor right now. What are you looking at in 2023?
Well, I came in with a bias based on history and, of course, the record inflation numbers that we had last year. And that is that, I did not believe that inflation has peaked, only taken a break. A lot of course, is based on what David just said, which is the fact that the Fed went from an aggressive tightening to more of a pause at this point with only 0.25%. It will be interesting to see what happens. But I felt that there were conditions that are well beyond the Fed's control for sure. A lot of it has to do with the fact that the inflation, particularly in the food area, although it's come down, I think still can be a major factor. Just look at the food commodities and the softs and you can see they're outperforming. And on top of that, if you go back in history a little bit, when we had the most comparable inflationary time, which would be the late 70s, the actual stock market itself, even though it fell, it really stayed in a trading range which had started in 1968 and didn't end until 82 once inflation's back was really broken. So I think we still have a couple of years to deal with inflation. We could have spikes in that inflationary environment based on what happens geopolitically. I would say number one concern. And number two is if the trading range persists, this 4,200 level that we saw in the SPX was basically based on a 23-month or a 2-year business cycle high. And that makes sense because what it's telling you is we did have this great rally, but can we really have a growing economy beyond that? And if we break over that 2-year business cycle, then of course, you have to change your mind. But if that turns out to be the resistance, the question is, where's going to be the support? if we continue to see a hawkish Fed, number one, and number two is you don't see any real growth other than the short covering that we had and the specifics to the AI industry.
Yeah, Dave, I see you shaking your head. You want to add anything there?
I mean, it's interesting as you're thinking about all those different components. What I'm drawn to is also just the seasonality, right? This is sort of the natural time when the market tends to rally. When you think about the 4-year presidential cycle, the midterm election year usually have a bottom in the fall, which we did last year. First half of the pre-election year usually tends to be pretty strong. So when Mish is talking about short covering, what's really fueling this rally, I'm drawn to just the seasonal tendencies, which a lot of times can make things seem a lot more constructive than they probably are underneath the hood. And I think that's probably the wake-up call moment that we have later in 2023 is when investors maybe recognize that the run in growth stocks has maybe gotten a little over the front of the skis of what is reasonable given the inflationary pressures that I don't think are behind us just yet.
Dave, so what are you looking at right now? How would you be deploying your capital if you had to put on a trade today or tomorrow?
Yeah, so I think in general, right, my goal as a trend follower is to focus on trends, focus on where there's strength. And you have to balance the trends that you're seeing in the charts versus the headwinds and tailwinds that are naturally part of your analysis of the broad markets. And I would say if you assume that rates remain elevated, which I certainly do, you've seen the 10-year pulled back, obviously, from 4.25, but now starting to rotate higher as bond prices are coming down. I think if we break above that swing high from December and continue a little bit further, which I think we do, that all of a sudden makes growth stocks a lot less attractive the higher rates go. That's where I'm looking at things like industrials, materials, areas of the market that are much more likely to do well in that kind of environment. Higher rates just don't tend to play well with growth stocks. You combine that with the fact that things like technology, communication services have had such a run. Now I'm starting to see a rotation a little bit to the downside. You're seeing some short-term weakness this year or this week, and I think that could be the beginning of a little more of a pullback. So I think we rotate a little more into value, a little away from some of the growth areas of the market that have been doing so well since the October low, sort of a reset, and then we see how things set up after that.
And Mish, I had the opportunity to talk to you on Yahoo Finance Live briefly a few weeks ago, and you said one of the possibilities is the market simply goes sideways from here and frustrates players both from the upside and the downside. Wondering how that may be factoring into your analysis, and I'll pose the same question to you. What are you looking at right now?
Well, yes, it definitely goes with what I just said prior about a trading range. And if we saw the top of the trading range, that means not necessarily we're going to have this big crash that so many people that are super bearish feel, but more that we can see a decline down to the lows that we had in October, 3,500, perhaps, maybe even 3,200 if things got dicey. So this has really been, this whole run has not really been led by institutional or even hedge fund money. It's been retail money. And so to me, it's really interesting that the last couple of weeks, particularly in the SPY and in the IWM and in the Qs, have been inside weeks. In other words, the range we had 2 weeks ago, we were inside that range last week, and we're inside last week's range this week, which means that we're getting into this compression here, which could blow my trading range theory right out of the water. We can take that out to the upside as easily as we can take it out to the downside. So in terms of positioning, right now, I mean, I have been very vocal about the metals and actually said if it dipped down to around 1850, 1820 in gold, that would be a buy opportunity. Well, we just saw that. And gold, as we're talking today, is green. And the reason why I still focus on the precious metals is because I kind of get this general sense, call it intuition or whatever, but I feel a freneticism around us globally and internally in the US that could unravel. So I like the precious metals a lot. I also like some of the defense stocks. I think that there's also obviously geopolitical concerns that could create a good buy opportunity, particularly in something like Northrop that had a huge sell-off and now looks like it's basing. I like some of the biotech space still. We've been long a couple of biotech stocks like Biogen and Vertex. We're long Teva. I saw Valxite, I think that's what it's called, PCVX, was making a move today and has been consolidating. Biotech's a good space to be because it kind of survives cyclicals and non-cyclicals. And I do like exactly what Dave said. I love construction and material as well. Floor, in fact, Dave, you mentioned that stock when we were talking earlier this week. Floor construction is one of our holdings. And the rest, I think, really you have to keep an active mindset to until we just see a little bit more how the dust settles, particularly with Fed.
Do you think this is going to be an ideal environment more geared towards stock pickers than passive investors? I've been hearing that a lot. And maybe this is kind of the realization of it, the fact that we're having so much, I would say, reorientation or rejiggering of the market of people's portfolios. It seems like on a dime, when we get a piece of different news, we've seen big moves in reaction, not only in the stock market, but also the bond market. But just wondering how you're thinking about trading. You've always been an active trader. So is this for everybody right now? Is this an active traders market?
Well, it definitely seems to be an active traders market. And I've always been a proponent of that. Of course, active, how active do you want to be? These positions that I just talked about, and particularly some of the food commodities that we own, have been positions we've had for a long time. So I think to Dave's point, going with what's trending is good. But as soon as that trend stops, you've got to get out. This is not a market where you can afford to sit. Well, I mean, one area we didn't talk about, which is more for passive investing right now, would probably be fixed income. And I know a lot of people who have taken money out of the market and gone into CDs getting 4.5%, and maybe they'll even be able to get closer to 5% next week. And that's where a lot of the liquidity is going to go. So yeah, if you're going to play in the market, unless you're really catching a good trend, you've got to really be prepared for things to change. Because I mean, even one of the Fed members said he has no idea where the economy is going. When you hear that from the Fed, doesn't exactly speak well to saying, I know where the market's going and I'm going to put my money and I'm going to sit here passively.
I'm glad they're finally being honest about this. Dave, your thoughts. So the environment for stock pickers, you think it's getting better? Do you think it's becoming necessary? Because one extreme, I heard one commentator say the other day that you could see most sectors actually finish in the red while individual names shine. So this would kind of be like a throwback to the 90s. We're not talking about energy outperforming. We're talking about individual names within energy, for instance.
So I think that's a really, really good point. And I would say a lot of investors, we obviously had a big influx of new investors in the last couple of years around the whole COVID era. And I think for a lot of new investors, 2021 to 2022 was a brilliant learning experience, probably a painful one, because, you know, I was taught everyone's a genius in a bull market. And the way I would add to that is that you can get away with a lot of bad habits in a bull market phase, right? When it's 2021, when it's a FANG-driven bull market phase, you can be in a passive product like an index fund or something like that and feel really good about your portfolio because those are the things that are driving the market higher. What we saw in the first half of 2022 was a very different market, which was value over growth, things like energy at times last year, things like financials starting to emerge, industrials. These are areas of the market that people don't naturally think are going to do well. So I think now we're separating what could do well or what should do well versus what actually is performing well. And it's focusing on where those opportunities are. That means I think you have to think less as an allocator, less of, do I want to own equities or not? And that means I'm owning the Qs or owning the spiders or something like that. And more thinking about where the opportunities might be. And you can have a scenario, which we've seen certainly at times in the last 12 months, where the major benchmarks actually struggle, but certain areas of the market actually do well, right? At times over the last 12 months, energy completely outperformed as a huge outlier. Industrials, big outlier. Financials, if you look at the charts of JP Morgan or Goldman or Morgan Stanley or insurance companies like PGR, these are really strong charts, despite the fact that the markets at times have been much more challenged. So I think this is a time to really focus on, use screening tools, use scans, and use your analysis of price trends to focus on where the opportunities are presenting themselves, and just be prepared that they might be in groups or in themes that you're not used to seeing doing well. I think that's the environment we've been in, and most likely that we'll be in here going forward. It's definitely, I think, more of a stock picker's market.
And I think this would be a good place to transition a little bit into investor education, because Dave, you just mentioned all the new investors we've had, and what an education. Somebody who just started deploying money, started trading for the first time over the pandemic. Most investors getting shellacked last year. A lot of the retail investors got wiped out the year before because a lot of the growth momentum stocks and a lot of the disruption stocks peaked earlier in 2021. So if anybody's trading right now, my hat's off to them for sticking with it. What do you say to some of these traders, Dave?
Hats off to the survivors, right? That made it to this point. That's good. Surviving to invest another day is a big accomplishment. So a couple things I would say. Number one, it's unfortunate in the English language that the words trading and investing imply taking action. And I think for a lot of newer traders, newer investors, they're compelled to do something, right? I would argue that if you're doing it right, some days investing should be incredibly boring because you need to be patient. You need to take a step away. Jesse Livermore famously said, there's a time to go long, time to go short, time to go fishing. And so I think there are times when you really need to sit on your hands and just see what happens and look for the right opportunity, right? Wait for the good pitches, as I would tell my 7-year-old son. Now, the second thing is focus less on hitting home runs and more on managing risk. Time I spent with investors like Peter Lynch and Bruce Johnstone in my Fidelity days, it was less about hitting home runs all the time. It was more about admitting when you're wrong. And as humans, it's really hard for us to admit that did not work. I'm no longer in the right position. I need to close this out, because when you sell something that's down 10%, you're admitting that that wasn't the right decision, or that the market is telling you something's not going right. So the toughest thing for investors to do is to admit that they're wrong, to move on. But I would argue that successful investors I've worked with have been able to do that, right? Recognize when the market conditions move against your portfolio, take action, and focus on the next opportunity. So I would say be patient and focus on risk. And I think that's a good playbook in bull markets or bear markets, to be honest.
Oh, I agree with you 100% there. I think one of the biggest mistakes I've seen consistently made by traders over the years, active traders, is the desire to get out at break even plus 1 penny or plus 1 tick. And the entire concept of anchored VWAP, we don't have to get into it here. Brian Shannon, I'm going to have him on next week. We're going to talk about that. It's subject of his new book, but it's basically figuring out where are the break even points for the average investor, because people are going to sell once they get to that. And having just gone off on that little diatribe, Mish, I want to get your 2 cents on the most important thing you would say to relatively new traders who have made it this far.
Well, first of all, I just want to say everything that David said, I totally agree with as well. I mean, risk is everything, putting your ego on the shelf, all of that. But I can tell you from my own personal experience. So I started out as a commodities trader in New York on the floor. And I knew nothing, absolutely nothing about trading. And when I went down there, you learn your lessons really fast. Number one lesson is that when you have all these commodities in front of you to trade, as we had on the floor, everything from coffee, sugar, to orange juice, to silver, gold, oil, financial instruments, you learn to follow what's hot. So momentum trading really becomes a key to success. And like Dave said, you don't have to necessarily go in for the long run. We would take a core position and then trade around that position. And sometimes that trend, more parabolic, was to the downside. So you also learn to be flexible to go short if that's where things were going, the old staircase up, elevator down. And number 2 lesson is exactly that, is that if the market is chopping, if there's no money to be made, it's a really good time to either find something that is trending or just sit back and hang out. I mean, we literally sometimes would have days where the floor would be so quiet, a bunch of us would just go to the movies instead of go fishing because we were sitting. So...
I get no comment on that. That's never been done in media, I can guarantee.
Right, but my point is this, is that really as a beginning trader, you have to learn about price action. You have to learn about momentum. You have to learn about risk. You have to understand some level of patience, but at the other side of that coin is get out quickly if it's not happening for you, and always have that cash at the ready to put to use when things are actually moving. And that's really the life of a floor trader.
Dave, I've built portfolio systems for a number of traders over the years, and just studying the classic momentum traders, one very consistent statistic that comes to mind is that only about 1 in 3 trades for a momentum trader works out. And if they're batting 33% or batting 33, that is actually a good record. In fact, that's not, I'm not a baseball player, but I believe that's decent in baseball as well. And it's about keeping those losses small. So can you tell me, from the mindset of a professional trader here, how to take these losses and how to prepare oneself mentally ahead of time to be able to do that, so one is not scrambling in the heat of the moment when we're getting that elevator down moment in the markets?
Yeah, it's really interesting. And when I've looked at statistics in my own work or seen others present it, when you look at what's called the momentum factor, which is this tendency of strength to beget further strength and weakness to beget further weakness in trends, and particularly in equities, the benefits over time of momentum are well proven, right? So over multiple cycles, sticking with trends has been a really good approach, particularly in that medium term time frame, sort of that 3 to 6 months sort of time frame. Tends to work really, really well. Here's the problem, though. If you look over time, though, you tend to have really big drawdowns. So you have better returns, but also deeper drawdowns. And those are tough. So a lot of times when I've looked at those, that evidence with financial advisors, right, investing for high net worth individuals, they say, that sounds great, and I'd love to have better returns, but my clients can't withstand those sorts of drawdowns. They won't stand for it. So I think if you are implementing more of a momentum strategy, you have to be prepared for that. You have to recognize the fact that, as you mentioned, well over half the time you're probably going to be wrong. And so I would say 2 things you need to do. Number one, have a really good exit strategy. And I often, compare investing and trading to flying an airplane. And what I would tell you is, you don't look for a suitable place to land. You don't get your checklist all ready when the plane is going down because the engine cut out. You do that when everything's sort of straight and level, everything's going well, you're flying with no problems. That's when you're always scanning the horizon, looking to see where you can land the plane if an emergency happens. And I think too often times investors and traders wait until something bad to happen to then figure out how they're going to handle it. You need to do it now, right? So positions that you're holding that are in the money, that are doing well, where you have a paper profit, focus on what you would need to see, what signal, what pattern, and then set an alert, set a trigger so that you're able to focus on those things and take action, as Mish, I think, very, very well said. Be courageous enough to take action when the evidence supports taking action. And the other thing I would say is it's all about having a good market awareness, right? Having a good sense of what's happening. A lot of times we get the blinders on, we focus on one particular position or one particular trade, as opposed to sort of scanning the horizon for all the different opportunities. Sometimes it's not even about just trading your particular stock or ETF. It's also about recognizing where the opportunities might be. There may be other opportunities that you're not exposed to at the moment. So making sure you're always looking for suitable moves. I scan for stocks making new 3-month highs and 3-month lows regularly, just for that reason, to make sure I'm not missing any potential opportunities out there.
Mish, your thoughts on risk management here?
Well, I have 2 things to mention. One is, again, everything that Dave said, and it's just simply called a stop. And so in terms of finding the opportunities in the scans, one thing that MarketGauge has done has created 10 different quant models, specifically because as floor traders, we've learned that you got to follow the momentum opportunity. The momentum can change on a dime. You're not always going to be right, and you have to have a risk management. So that's all, in essence, has saved us a lot of time in constantly having to do it manually. We're doing it automatically. But even if you're a discretionary trader, I start every single trade with, what is the stop loss? How much am I willing to lose on that trade? And that is so important because that's only one part of the equation. The other part of the equation is, in that loss, what percentage of my overall portfolio is it? Because some people will say, I'll buy 10,000 shares, but I'll risk 50 cents. And that turns out to be more than 5% of their overall portfolio. No one should lose more than 5% on any single trade if they understand the whole idea of position sizing. Van Tharp was the name I was trying to collect there in my brain. Mm-hmm. He wrote a lot of books on that. So it's 2 things. It's A, where am I wrong? And then you completely detach from the outcome. And 2 is, have I put the right amount of money at risk so that I'm only willing to lose 0.5%, 1%, 2%, depending on how many other instruments you have in your portfolio. And then I think you have a winning formula to stay with trading for your life.
I want to pivot now because that was some great advice. I want to get back to some charting action, and we got to talk about crypto. And I'll start with you, Dave. And unfortunately, I don't remember. Not everybody trades crypto, but everybody can read a chart. So here is everybody I invite on the show can read a chart anyway. Here is what looks like to be about a 4 or 5 year chart of Bitcoin, and we are off of the lows here. What do you think about this?
Yeah, so I think, honestly, I think everyone needs to have an awareness of cryptocurrencies. Whether or not you're actually investing them, you have to recognize this is now not an emerging asset class, but an emerged asset class. And there's a lot of noise, right? There's a long tail of smaller, less liquid, altcoins that are probably not ideal for most investors. But things like Bitcoin and Ether and others are pretty widely followed and have the opportunity, I think, to certainly have I think these are things we'll be talking about for quite some time. If you look, when I mentioned earlier about a change of character, I think that's one of the ways I tend to identify that something's different on the chart. Something clearly changed in the fourth quarter of 2021 for Bitcoin. Making a new all-time high in the 60,000s, getting almost to 70,000, and then just rolling over, and then making this consistent pattern of lower lows and lower highs. What was most meaningful to me on the chart of Bitcoin, if you look in sort of March of last year, you look in July, August, you saw where we briefly broke to a new swing high. We made a new swing high and then immediately failed. And that's really more characteristic of a bear market phase, right? A bear market where something's going down overall. In the short term, you'll see these short-term rallies, but there's no follow-through, right? There's no upside follow-through after the rally. That arguably is changing right now. If you look at the chart of Bitcoin and sort of focus in around 21,000, 22,000, you'll see that we broke to a new swing high. We pulled back and made this arguable higher low there in February, now rotating back to the upside. Charles Dow, over 100 years ago, made it very simple. He said an uptrend is a pattern of higher highs and higher lows. And when that pattern persists, I think you need to determine that that's the primary trend. I think for Bitcoin and Ether, we've sort of rotated where the primary trend is now bullish. So I think you need to mentally shift from the sell the rips mentality, which was very suitable last year, to the buy the dips mentality, which I think is now probably going to serve us well. As long as we hold that swing low from February around 21, 22,000, I think it's a pretty strong chart with certainly plenty of upside potential.
Mish, I'll get your reaction here to Bitcoin.
Well, a couple things to add to that. Obviously, time frame is important. And so the fact that it stopped just shy of 25,000 is interesting, because that's where you have a convergence of both the 50 and the 200-week moving averages. So right now, I agree that we have a tremendous amount of support at 20,000, 21,000. And if we can get back down there and hold, that would be great. But this 25,000 is also very key right here. The other thing I want to add to that is Bitcoin itself it's actually part of my economic modern family. It's my latest member. And I always call it an adolescent, because I think it's still trying to figure out what it wants to be when it grows up, relative not just to itself and cryptocurrency space, but to the whole U.S. economy. And I think we still don't know, is this going to react to higher interest rates like it did in 2022? Or is it now decoupling from that and becoming more in line with kind of what we talked about before? A spark plug is a place to go because people will believe more in the decentralization than they will in fiat currency. We don't know that exactly yet. That's the fundamental. And the last thing I'm going to say is we trade a lot of the altcoins. So we just made 45% in Avalanche, for example. I think we have a position in Solana right now, too, through our model. So what's also interesting about this space is no matter how much regulation they try to threaten to throw at it, no matter how much bad press it gets, and FTX and all of that, the thing is that it's hanging in there. So it's definitely a viable future. But right now, I think, too, maybe this new range would be 20 to 25 until we sort out what's going to happen next, everywhere in terms of the economy here and abroad.
I want to talk about another hot trend and that's been captivating investors' imaginations as well as everybody's imaginations. That's AI, artificial intelligence, ChatGPT being rolled out over at Microsoft, being integrated with the Bing browser. I've had a chance to use this. I find the technology incredible. I think it is going to spark a new deflationary wage, but it's going to take years and years to play out. Just wondering if you guys are thinking about that, and if it's on your investing radar, how you are thinking about playing it. And let's go to Dave.
Yeah, so absolutely. And there's a guy, John Markman, who's an author, wrote a book, and I forget the title of it. I'm so sorry, John, but he wrote a book about really thinking about long-term trends and themes, right? Things like AI, electric vehicles, and focusing on sort of all of those bigger picture themes that are not necessarily an immediate theme, but it's something that probably is going to evolve over time. Fast forward investing, that's the title. Thanks, Jared. So, as you're looking at these themes like AI, electric vehicles, and others, the question is the timing of it, right? The question is what's the right timing to go for that. These are themes that I think no doubt AI will have broad implications going forward. If I look at a chart like IRBO, which is a robotics and AI ETF from iShares, it's had a pretty exceptional run, much like much of the sort of emerging technology. You call them the ARC names and those spaces have had really good runs to the upside. But now all of a sudden they've had arguably excessive runs to the upside. And we have ways of determining that using technical indicators, things like RSI, looking at momentum. A lot of these charts like Tesla and AI ETFs and others became overbought there at the beginning of February, meaning they moved so high so quickly, you're arguably sort of overextended. You're due for a bit of a pullback here. So I think those themes, there's no doubt that the theme will work. The question is what stock, what ETF, what approach actually gives you exposure in the at the right timing to benefit from that. I think it's unclear as to where what companies and where the real growth is going to happen, or who's really going to benefit from it. So I go back and forth between thinking of a broader ETF exposure, something like IRBO, I think is a decent way to sort of play the theme, but also thinking about some of the larger names, so for payment processors, things like Square and others, some of the larger names like Microsoft and others certainly are going to benefit from the growth in AI. So I would be looking at opportunities there.
Yeah, I've been hearing, since the space is small, one of the articles I wrote this week happened to be right up on my last Yahoo Finance Uncut interview with Raoul Pal. And he was saying, you can look at the bigger players, Microsoft, Alphabet, they're already pivoting toward AI in a big way. Their entire business model, not just segments, their entire business model. And NVIDIA is a big player too. I'm wondering, Mish, what are you thinking about artificial intelligence? No DC references, please.
Can I reference Cathie Wood? Because she obviously has had a lot to say recently on media about the future of AI. And she's 100% right that it is the future, obviously. There's a little bit of a dystopian side to that, though, that scares me, possibly because of my age, in the obsolescence of human beings. If AI becomes so efficient that really basically a lot of jobs will go away and a lot of reasons for why humans even exist will go away, and it will all be dependent on technology. But for right now, that aside, I think that the bigger point is mass adoption. And even though we see companies like Microsoft and NVIDIA and Google and Meta all going there, again, we're in a cycle. If you look at the Microsoft chart, that it stopped right at that 23-month, 2-year business cycle high, which tells me that there was a lot of euphoria with all the publicity that it got and all the great amount of buying that came in because they were so oversold. But it's not quite proving yet that this is the next great big thing, other than it will be at some point. And the best example I can give you is 3D printing. I was like the biggest proponent.
I remember this.
Yeah, 2018, I was like, DDD, that's all I thought, oh my God, this is the greatest technology. Why would we ever take wood from the ground when we can build 3D houses? Why would we have any problem with biotechnology if we can 3D print organs? And what happened? The stock went crazy. And then it never really hit the retail space. The money that had to go to research and development went to stock buyback and investment, not necessarily in 3D the systems, that company, but in other companies. And it's basically just floundering now, even though I think 3D technology is the way of the future. So there's the idea, and then there's the timing. And of course, it gets back to good old technical analysis and just making sure that you keep them on the radar. But I wouldn't be jumping in right this second right now, given the current environment we have.
It does take a long time for these things to play out, and we could talk about the S-curve all day, but we want to talk more about charting and I guess good habits in trading as well. I guess, Dave, let me give you the floor here. Do you have anything, maybe a pet peeve, something that you've been seeing on Twitter lately that you just want to say, can we just get over this, or can we do this a little bit differently?
You're urging me to throw people under the bus, and I'm not going to do it, Jared. But I will. No, so I will say, yeah. There's what's funny about the world of social media. I would say there are really good things about the fact that everyone has a megaphone with which to announce your analysis. I've always told people, just because you have a megaphone in your hand doesn't mean you need to push the button and start speaking. Like, do that when it's actionable, when you think it's a good time for it. When I look at a lot of the conversations I see on social media about charting and technical analysis, which is obviously an area of focus, I find that a lot of times people overcomplicate things. If you look at the charts that I would bring up, or the charts that Mish would bring up, or that you're bringing up, Jared, which I think you can put your hat on as an honorary technical analyst for sure, if not more. They're relatively straightforward, and I have found in my experience that the more complicated, the more busy you make your charts and really your analysis in general, it becomes much more curve fitting than you probably realize. A robust process means you can apply it to different cycles, to different timeframes, to different opportunities. And for me, robustness, the best robustness check is, how simple is it, right? Is it simple enough that you can explain it to someone, that you can apply it consistently? And so when I see someone sharing ideas with a lot of stuff on there, I get a little bit itchy. So I would encourage people to keep it simple, to focus on a key level. I always talk about a key line in the sand. Forget about all the techniques, all the indicators. What's the level? What's the signal? What's the one thing that you're waiting for? And for me, looking even at broader asset classes like the S&P, or with bonds, or with gold, just identifying that line in the sand and being patient and waiting for it has been a much better approach than trying to overcomplicate my analysis.
Yeah, if we can just show our charts here for a second, I want to show off all the indicators we have over at Yahoo Finance, and we can scroll down this list. I find I use some of these and some of them I don't, and I don't want to discourage anybody from not trying something out, but that it really gets down to the potential problem of analysis by paralysis. There's something called indicator fascination, which I read about many, many years ago, which I had at one point. And really it is about getting back to simplicity here. And that's why I love these candlestick charts, because supply and demand just kind of presents itself to you or to me. And I see trend lines here. I see horizontal areas of support and resistance. So Mish, I'll give you the floor now. And you can go off on a rant, or you can just talk about what you like to see in some of your charts.
Well, I just want to say that probably Dave Keller, Jared Blikre, and Mish Schneider are three of the most underfollowed people on Twitter.
Follow us, please.
What they should be, okay? I just want to start with that, because I'm always amazed at people who have hundreds of thousands of followers and they offer nothing real substance. So I never really could understand what makes you more popular or less popular. You can provide the greatest content in the world, and all three of us do. Very simplistic and very focused and very consistent. Those are the things. And that's what I love about the people that I have followed for years, or the news services on Twitter. So I just want to start with that. I totally agree about analysis paralysis. Again, I have to go back to my days when I started point and figure charts. And I would get a weekly magazine called Commodity Perspective, where I would hand draw the high, low, open and close on the charts and create trend lines. And that's it. All I learned was flags and consolidation and trend line breakouts. And actually, that simplicity was so much better than all the stuff that people throw at you now. And even with all of this, if you look at my charts, I have volume. I have a 50, 10 in a day on the daily, a 50, 200 and a couple of exponential on the weekly, the 23 and 80 month on the monthly. And then I have a 30-minute and a 1-minute chart. That's it. And with some pivots. I don't get into all that other stuff because I find it is mind-boggling. So yes, I mean, when I see people post these charts on Twitter and they have so many lines on them, it's blinding. I just don't follow that person, or I just continue to scroll until I find something of value. And there's a lot of value on FinTwit. I will say that. I think it was life-changing for me when I first joined it in 2009.
Well, yeah, that brings up a great point, because one of the things as independent traders is we can get lost even in big cities. So I know I believe you're in Arizona right now, but if I'm, over the pandemic, many people were isolated, but we'd had these forums that had evolved over the year, not only FinTwit, but also Reddit. But back in the day, I remember when I started trading towards, this was about 20 years ago or so, didn't really have a lot of these tools, and it was a bit isolating, and it was difficult to find good resources and trustworthy resources. Lots of snake oil salespeople out there. Just wondering who you follow, Mish. Who do you like? Nobody in this room, please.
Well, in terms of traders, I like, oh God, now you're going to ask me to remember, Scott Redler, is that his name?
I think so.
Yeah, I
know his work.
I follow him. I follow some great commentary because they don't necessarily tell you what to do, but they bring a really fun twist to it, like the Blikre letter. I like him. I follow Liz Ann Saunders just to be able to get all the economic stats and the most updated charts on those stats.
Every morning.
Right. And I don't follow a whole lot of traders, really. I mean, there's a couple of others. Chess is a guy I admire. Another guy, his handle is HCPQ. I think he's very good, particularly in NASDAQ. So I pick and choose. Mainly, it's mostly news sources, so that I feel like I can really decide for myself what the news is. Mm-hmm. And then like the handful of traders, and that's really kind of it.
Yeah, the selection of news, I think, is really important, because there is another way to get just bogged down and paralyzed by analysis, by the constant barrage of news coming out. Dave, what do you look for when you're looking for outside sources? Is it Twitter? I'm guessing maybe not Reddit, and then are you looking for news, just trade ideas? What gets you interested in sticking on somebody's feed for a little bit?
Yeah, it's a really good question. So for me, I spend probably way too much time looking at charts, right? That's my profession. So as a technical analyst, I look at probably thousands of charts every day. So I don't follow, I certainly engage with other chart and analysts, but it's not, I sort of have that really well covered. So I like thinking of other perspectives so I can relate what I'm seeing on the charts with the big picture. So, someone like Sam Stovall from CFRA Research, more of a strategist. Someone like Gina Martin Adams from Bloomberg, Tony Dwyer from Canaccord Genuity. These are more macro strategists, and relating what they're seeing in terms of their broad analysis of business conditions, economic conditions, earnings trends, right? And thinking about earnings season. That's really helpful, because I think arguably the charts reflect all of that. But understanding their toolkit and how it relates to what I'm seeing independently on the charts are really helpful. The other thing I would say with people that break down market history, so randomly people that would come to mind, like Charlie Bilello comes to mind, Ryan Dietrich does a really good job. They're really, really good at pointing out, here's something that's happening now, here's the last 10 times that's happened, and here's what's tended to happen after. While there's no guarantee that analog is going to hold, I love thinking about how now relates to some other period. And to be honest, you said don't mention anyone, but I know in conversations with Mish, we've talked about, what does this feel like? What year does this look like or feel like? And drawing on our experiences in investing and in trading to, try to have some historical reference, right? What has it been like in an inflationary period? What has it been like in a period of rising rates? And I think that's where some people have a lot to offer, for sure.
Well, I'll bite here. What does this most look like to you, this period in time historically?
Ooh. Really good question. I love that question. So I would say so this, right? I think you have to look back at a time when inflation was a challenge. I think you have to look back for at a time when we were in the middle of a bull market phase, but not sort of at the end of it. So there are a couple parallels that I think are pretty interesting. From a technical perspective, I'm seeing a lot of similarities to sort of the mid-90s, which would be sort of in the middle of a run, sort of a recovery, and then potentially a move back to the upside. It's not necessarily the best economic parallel, but I think from a technical perspective, we could be sort of in that environment, sort of middle innings, 6th, 7th inning of a larger bull market phase, the end of which and the finish line of which is still an open question.
And Mish, analogs here, please.
Well, for me, it's definitely got to be the mid to latter 70s into the early 80s, because even from a global standpoint, and actually one of the biggest differences from that period of time to now is globally, inflation wasn't as big a problem. It was only a few countries that were impacted back in the late 70s. Now it's much more global. But, if you just look at the division of the country at the time, the impeachment of Nixon, the Jimmy Carter years, the fact that they started to devalue the dollar and lower interest rates in a period of uncertainty. And then on top of that, you had obviously on the heels of the oil embargo, and then you started having some real issues with some of the crops. One of the reasons why sugar made an explosive move in the late 70s was because the crops were so bad in Russia, they stopped exporting. So there's, they say that history is parallel, doesn't necessarily repeat. It's very parallel to that period of time. And of course, when we got into a new economic period with Volcker coming in and then Reagan becoming president, things started to change and growth happened. But really the 70s, we were stuck with a real lack of growth because everything that was going on in the country was being directed towards foreign policy, towards the Vietnam War. And even though we don't have anything like that right now, exactly, we have spent trillions of dollars in the Ukraine. And so that's really where I'm at right now. I think we could still see a big period of inflation, maybe even on steroids, because, like I said, we have a more global situation than what we had back then.
It's hard to think that this doesn't develop some secular legs, and we will have to see. I got some bad news. We only got about 2 minutes left. Just got a notice from my producers here. So I'll give you the floor one more time, Dave. If you just tell me anything that comes into your head that you want to close with for in the next 30 seconds or so.
No, this has been fun, and thanks, Mish, and thanks, Jared, so much for setting it up. This is a pleasure to chat with you guys. And I would say what's really cool about the investing journey, the trading journey, is that you're always learning. I always tell people one of the first industry events I ever went to, a guy a couple seats down from me was in his 60s and was asking questions about investing. And I remember thinking, I was in my 20s. I remember thinking 40 years from now, if I'm asking questions like that and still learning, what a cool way to spend your time. So I've enjoyed the journey thus far, and I will enjoy hopefully many, many moons beyond today, and always be learning is my recommendation.
And Mish, final words?
Well, same thing. I'm so happy to be with two of my favorite people in the business today. So thank you for having me on. Yes, learning, my God, I think that trading is the greatest metaphor for life. They used to say on the floor that markets are your best psychologist. And so as a result, since we never really know ourselves fully, or we always surprise ourselves or learn something new, that's exactly what happens and is mirrored in the market. If I had to leave some tangible advice, I would say to watch the US dollar, because there's a point where it goes down that is good for growth stocks and good for commodities. And then there's another point where it goes down and it shows that maybe something is breaking in terms of the support that the U.S. has counted on as an industrial and leader power foreign policy-wise for all these years. And that right now is why I go back to the 70s, because that was when the U.S. was really losing a lot of face. And I see some parallels now. So watch that dollar, because if the dollar holds up, that's a good sign. If it starts to really crack from here, not such a good sign.
I can't believe we didn't even get into all the macro stuff I wanted to. We got to close it here. Really appreciate all your wisdom and insights here. Mish Schneider and Dave Keller here on Yahoo Finance Uncut.